welcome everybody to our webinar today on Delaware statutory trusts. We decided to do a webinar on this because everybody wants to know, what do I do if I can't find a suitable 1031 exchange property in the 45-day identification window for a 1031 exchange? And this is one of the options. And so we brought in 𝐉𝐨𝐬𝐻 and Hunter Jones with Passive Realty Group today to talk about that topic. My name is Brad Uhlig. My business partner is Jay Peterson. We from a condo up to a 20-unit apartment building. We can help you find it, analyze it, buy it, manage it, flip it, pretty much anything you want to do in the real estate world with regarding to buying and selling income producing assets. We own properties ourselves. We've been doing this for 13 years now. We have lots of experience and have done hundreds of transactions. So there's probably, if we haven't experienced it ourselves, we probably know somebody or one of our clients that has. We have a pretty extensive network of investors that we've built up over the years. I think we have about 5,000 on our investor list right now. And so it's often, it's not uncommon for us to do transactions off market where we plug a buyer in with a seller and it never hits the MLS. So it's always a good idea to reach out to us first if you've got any kind of real estate need, whether you're on the buy side or the sell side, and see what's cooking in our neck of the woods before you do anything else. We don't do property management, but we do work with experienced property management partners. So if you're looking for property management, please reach out to us and we can help you sort through that as well. We do these webinars from time to time. I think we did 3 webinars last year. This is our first webinar this year. And you can find our past webinars on our website. If you go to the education tab of westpeakproperties.com, you'll find links to property or presentations on Section 8 rentals, short-term rentals, property management practices, cost segregation strategies, etc. So please reach out and do that as well if you need to. So our guest speakers today, again, 𝐉𝐸𝐬𝐻 and Hunter Jones with Passive Realty Group. And I'm going to pass it over to Hunter now and let him do his introduction. He'll kind of give you the background on who they are and what they do and how long they've been doing it. We're going to hold questions till the end. Feel free to type any questions in that you want through the chat. Jay is going to administer the questions, but I think it's going to be more efficient if we go through the presentation first and then do all the questions at the end. That way we don't get sidetracked as we go through this, and it'll be a better experience for everybody. So Hunter, go ahead and switch over and we'll let you take it from here.
Great, Brad. I'll actually let Reed do the intro, and then I'll take the kind of nuts and bolts of the DST.
Okay.
Yeah, well, thanks everyone for being here. Brad, Jay, we sure appreciate the opportunity. Today we're going to share with you and your clients an alternative way to approach a 1031 exchange and how Passive Realty Group and our platform can be a really nice solution for those on the fence or hesitant to sell their property, like Brad mentioned, without knowing what their replacement property or properties may be or may look like, or if you even have the ability to get what you think you're going to get in this marketplace. Simply put, I mean, this is not a sales presentation, very much an educational forum for you to learn about this not as well-known 1031 solution. And I'm going to ask Hunter, my business partner, to run through, like I said, a brief presentation on what a Delaware statutory trust or DST actually is, along with the structure, a couple of examples, what the benefits are to investors, and finally, how they can fit as a high quality 1031 exchange option for not only backup, but maybe some boot or leftover in your exchange, or potentially your entire exchange, which is, the majority of our clients do fit a combination of one of those 3. As I'm sure many of you are aware, the 1031 exchange tax code is the IRS code we use to preserve our purchasing power by deferring all taxation. Now remember, that includes depreciation recapture tax, that includes federal capital gains tax, state capital gains, the ACA, otherwise known as the Obamacare tax. So we defer all of those through the use of the Again, IRS 1031 tax code. DSTs themselves is not the bright, shiny new car on the lot. They've been around for about 2 decades. Okay, they've been used time and time again for exchanges throughout the country in all 50 states. I think I have clients right now, Passive Realty Group has clients in 28 or 30 states at the moment. We've got properties all over the country in every major asset class. Brief background on us. Again, we're Denver based. I have built the largest platform of non-proprietary DSTs in the nation. So we don't sell anything that we have a conflict of interest on. And again, simply put, all we do day in and day out is look at deals that cross our desk and make sure we're putting the most suitable offerings in front of clients to solve their goals or needs. I've been doing this about 10 years in the DST space. Again, DST has been around nearly 20. The DST equity side of it has grown to about a $7 billion a year industry. The reason, again, is simple. It's a very wide swath of real estate investors or owners that have appreciated real estate. They're tired of managing their tenants, the toilets, the trash, the building issues, the landscaping, you name it. And they want to use the 1031 code and all of its benefits, but they'd much rather have something completely passive and hands-off, institutional quality, and paying monthly cash flow. And that's all that we do. Again, we've got clients all over the country, and we've placed equity into about $1 billion worth of real estate. One thing to keep in mind, every solution that we generate for folks is custom. Every family has different situation. Every family has different goals, sometimes many. And that's why we do not have we're not a one offering shop. We have many, many different solutions that can fit a variety of different client needs. Potentially you have certain cash flow targets you're trying to hit or asset class preferences. You want to hedge against inflation, certainly in this environment. Maybe you have a liquidity concern. Potentially, we're looking at non-recourse debt to add to cost basis and get some larger depreciation and tax sheltered income. Or we could just be looking at backup options. We do that day in and day out, backup identifications for folks. So at the end of the day, our job's simple. It really is consultative to educate, understand needs, provide solutions, and walk our clients from A to Z through our turnkey and 100% passive 1031 opportunities. So with that, I'm going to have Hunter share some highlights of what a DST actually is. Again, as this is meant as a high-level overview, you probably have plenty of questions, so type them in the chat box. We'd be happy to answer your questions, but if we don't get to you, feel free to reach out to us directly. We are here to help and be a resource regardless whether you use our services or not. So with that, Hunter.
Great. Thanks, Reed. Hi, good afternoon, everyone. My name's Hunter Jones. Thanks a lot for joining us today. And thank you, Brad and Jay, for letting us co-host with you. So very excited to be able to share some of this information, expand on what Reed was just talking about, and share a little bit of more detail about these unique 1031 solutions. So let's jump into it. First bullet point that I'll discuss really is what is a DST. In short, a DST is simply a prepackaged 1031 property that, as Reed said, is completely hands-off, institutional quality, and paying monthly cash flow. That's extremely high level, but if I back up a little bit, as Reed said, this DST structure, it's been around for almost 20 years and really has quickly become the fractional ownership structure of choice. So really multiple investors, fractional ownership. Last year in the DST space, there was Reed said it was about almost $7.5 billion in equity placed. If you look at the graph here on the far right for 2021, so almost $7.5 billion last year with 265 different DSTs, so different offerings structured by 42 different real estate sponsors. This is something that's obviously recognized as 1031 eligible property for replacement. It includes every imaginable asset class: multifamily, storage units, industrial, retail, student housing, manufactured housing, office, even oil and natural gas mineral rights. So sometimes people get tripped up and think that, hey, I sold a duplex here in Denver in Colorado, and I have to replace with another multifamily asset. That is not the case. We can replace with a variety of different asset classes. As examples of DSTs, Reed said we're Denver based. As examples of DSTs here in Colorado, I guess about this time last year, we had a brand new 300 unit Class A apartment building up in Fort Collins that was structured as a DST. And then I'm sure everybody's seen it, but the about 850,000 square foot Amazon distribution center that's right off I-25 on the east side of I-25 was structured as a DST last year as well. So it's nice to see occasionally some assets here in Colorado. These are structured and completely managed by large commercial real estate companies. We call them sponsors, so you'll hear me use that term throughout this presentation. But these sponsors, they have years, decades of experience through acquisitions, through leasing and management of these type of products, REITs, and various commercial real estate assets. These sponsors will ultimately sell the DST, sell the property, usually in 5 to 7 years. And really, I'll tell you, not all DSTs are created equal. Every single, there's probably 50 different DST sponsors in the industry right now, but every single DST sponsor really has obviously their own individual track records, their own backgrounds, maybe their own asset class preference or asset class focus. And I think Reed and I really tried to whittle the list down of available DST sponsors and work with the highest quality, best in class sponsors. We generally don't work with first-time sponsors that have had any kind of corporate issues or major issues at any properties. We try to dig into that. I think we treat our clients like it's our own money. We put our own money into these deals, or it's our parents' money. So we really dig into these offerings very much in detail. DSTs really are designed to be a very conservative way to facilitate a 1031 exchange, as generally the offerings, they're newer buildings, fully occupied on that multi-tenant side, or if it's on the single tenant side, they're going to be corporate credit tenants with fresh 10, 15, 20-year leases with rent bumps built into them. You will never see any type of development, large-scale renovations, any high-risk single tenants in these properties. You'll never see anything that's a medical marijuana retail store. You won't see any kind of strip centers that are, a liquor store or a dry cleaners or anything like that. These are really designed to be more of kind of a singles and doubles versus hitting home runs for clients. And I think we're okay with that. Our clients are okay with that. So we always tell clients, the DST's primary goal is really capital preservation. So if you put $100,000 into a DST, we want to get $100,000 out when it is sold. So that's the primary goal, capital preservation. I'd say obviously the second goal is a solid, steady, predictable income stream. If we tell someone, hey, we're gonna get you 5% cash flow for the next 7 years, we want to be able to deliver on that. And then obviously we do want some sort of appreciation when the DST is sold. But those are really the primary goal: capital preservation, solid income stream. Icing on the cake is getting some kind of appreciation when it's sold. So really, this is more of a I would say an under promise, over deliver type of solution for clients. DSTs, they're actually sold through what's called a private placement memorandum, or a PPM. It's much like a prospectus for a mutual fund or an ETF. This is really where everything about the property is fully disclosed. So we get copies of this, we provide it to our clients, but it's where you would find the description of the property, the business plan, the risks, what the submarket looks like, what the financing looks like, third-party reports, your fees, your legal opinion, and really the underwriting of the property. So Reed and I always try to emphasize these are really probably more fully disclosed than when you and I and everybody on the webinar here goes out and buys something on the traditional side. So that's, again, I think in short, again, these are really just prepackaged 1031 properties, completely hands-off, institutional quality, and paying that monthly cash flow. Let's switch gears a little bit and talk about the structure and more of the advantages of the DST inside of a 1031. So first of all, DSTs are really going to allow investors access to, I always try to emphasize, either institutional quality property or a higher quality property and a higher quality tenant that is structured by these sponsors that, again, have decades of experience and really do this, day in, day out as their jobs. Number two here, they provide a completely passive ownership experience from A to Z. The sponsor handles every single aspect of the property. So as Reed said, we aren't dealing with any kind of tenants, toilets, or trash. You will never get a phone call about anything like that. So that's a big, I think that's one of the biggest benefits of this structure. Diversification. Diversification, as these are generally $100,000 minimums. So lots of times we can place clients into 3, 4, maybe even 5 different offerings. Sometimes folks say, hey, I just like this one single DST, I'm good with that. Or a lot of times we really try to diversify folks into a handful of different offerings, which just allows clients to really diversify their real estate exposure by asset class, by geography, by tenant, et cetera. So DSTs, I think, can really mitigate a lot of risk that's traditionally inherent in real estate, or owning one single asset or owning just a single asset class. Non-recourse debt. So debt, Reed talked about this a little bit, but debt is built into many of the offerings that we have. There are some here and there that are completely debt-free, but probably 90% of the deals that Reed and I have, they have some sort of debt already built into the deal. The debt in a DST, it's modestly leveraged, usually 40 to maybe 55%. The debt is non-recourse, obviously, as it says here, so it's not on your personal balance sheets. We don't pull credit checks, but the nice thing is the debt is assigned to you as a percentage of your ownership, and obviously counts towards your 1031 debt replacement needs. If you obviously are replacing debt in your exchange, then we can mix and match and get right to your debt levels. I'd also add, many times we add debt to someone's exchange that adds to their cost basis, which just allows them to depreciate more of the property and shelter more income through the taxes there. So also, debt is institutional rate financing. So I think that's another big advantage of working with the DST and relying on sponsors to put this together, is that the sponsors are really able to secure more attractive financing than you and I are able to go and get out on our own. Simple tax reporting forms. So you receive these generally in February, March, that you simply can provide to your CPA, but shows obviously your percentage of the income, depreciation, and expenses that you can put on your tax form. Estate planning, well, we talked about lower minimum investment, number 6 there. Number 7, estate planning flexibility. As I just had this conversation yesterday, these are very easy to re-register ownership and various percentages to beneficiaries. And then I just also add to this, I think there are, our industry has evolved over the last number of years, and I think there's a handful of unique solutions that allow for liquidity and various needs that I think our industry is becoming more aware of, and trying to structure their DSTs to fit some more common goals of clients. So it's not just estate planning flexibility, but we have solutions that allow for liquidity. And as Reed said, we take a very consultative approach to working with clients and putting solutions in front of them that meet their needs and their family's needs. And then closing with confidence. So, lastly, I'd say we're always going to have 10 to 15 different offerings that our back office has done due diligence on. Reed and I have done due diligence on. Occasionally we will go to properties ourselves, and it just allows us to really, like the stories more. We're always going to have, like I said, 10 to 15 offerings. So we're always really going to have equity for someone, if it's, as Reed said, if it's boot, or if it's leftover funds of $100,000, or someone that has a $10 million exchange, we have the equity to be able to secure that. So great options for boot, for leftover, as Reed said, even backup IDs in case you're buying something traditionally here with Brad or Jay, and maybe it falls through for whatever reason. So I think, as you can see, those are some of the high level, very nice benefits to the structure that really allow clients, I think, more time to focus on other aspects of their lives, gives them peace of mind through that diversification, through that passive nature, and the institutional, higher quality properties and tenants that these provide. On the flip side, some of the things to consider, and we always bring this up with clients, but on the flip side, I'd say these are illiquid offerings that we need to plan on holding for 5 to 7 years. Some will sell sooner. Every single offering is a bit different. Every single sponsor, they might have a game plan of selling it in 3 to 5 years, or they might have a game plan of holding it closer to that 7-year time frame. But there isn't really, as it says here in the number 2, there isn't really a secondary market for these. Some folks who do what Reed and I do might say that there is a secondary market popping up, but it's not an efficient market. I imagine you'd be taking a haircut and probably getting, I don't know, 70, 80 cents on the dollar. So really we need to plan on holding it for that 5 to 7 year time frame. Number 4, investors do not have a say-so in the property, as we leave that to the sponsors. Reed and I view this really as a benefit, because these sponsors are the ones with vast experience, large scale to handle any kind of situations that may arise. And obviously they're the ones in this industry that have relationships a lot broader than you and I do. When a DST is sold, when a DST is sold, investors have every available option to them that they normally would. They can 1031 into another DST. They could go out and buy something traditionally with Brad and Jay, or they could choose to pay the taxes at that point in time. The last bullet point here, as far as fees go, these are going to be pretty comparable, I think, to what it costs to sell and to buy a building on your own, as you obviously have your brokerage fees, you have your third-party fees, you have your closing costs, et cetera. We might be 1 or maybe 2% more, but you get what you pay for. You get a property that's freeing you up of time, gives you a higher quality property, and again, something that gives investors peace of mind. Some other things that I might add to this to consider: these are sold to accredited investors. So what does that mean? Since these are illiquid, they do need to be sold to investors that meet certain income or net worth standards. I'm sure many of you have heard of the accredited investor status, but you either have to have a net worth of $1 million excluding your primary residence, or have had income in the last 2 years exceeding $300,000 if you file jointly, or $200,000 if you file as a single individual. So those are the advantages and considerations of really utilizing this structure. I really think once people start working with Reed and I think they start to understand how this product is organized. They understand those benefits, and we don't have too many clients that really get caught up in that illiquidity or that giving up control side. But these are all the things that, again, we try to take that consultative approach when we're working with clients and talk through, so that everybody understands those benefits, and that everybody's on the same page of what to expect when going into a Delaware statutory trust. So really, I'd say in conclusion, I know we were just talking about this before we started. It's a very interesting, it can be a very challenging environment right now. Obviously, real estate values are elevated. I think it's very tempting for folks to want to try to capitalize on that, on those prices right now, but you might be concerned about what you would replace that with. Again, we're always going to have 10 to 15 different offerings that might fit those goals. Reed and I are certainly here to help educate you more, help provide various ideas for every single different circumstance that is out there, to make this a very simple process for you. So that's really all I have prepared for today. I hope that obviously gives you a better understanding of what a DST is, those benefits, those limitations, and just how we work and how we can help provide a variety of different solutions for various exchanges. So Reed and I say thank you very much. I think we'll open it up to some Q&A.
So Hunter, I just have a comment here. Jay and I are brokers, and we help people find replacement properties. We look at a DST as sort of a backup option in case we're unable to help them find that property. Or if they buy a property, let's say they sold a property at $1 million and they find a replacement it's only at 800,000, then they can roll that additional 200,000 into a DST and not pay the taxes on that. So we look at this as a tool. Most of our clients have been hands-on and like that, but some of them, it might be the perfect fit for them, that they want to be more hands-off, or they want to have options in case they can't identify that property that they want to. So I really appreciate you guys coming in and doing this presentation. And we do have a number of questions, so I'll let Jay take over on that, and I might have a question or two myself, but we'll let others go first.
Yeah, I probably have a couple myself as well. But the first one here is, can a broker receive a commission if they refer a client to this DST?
Yeah, and that's from Chuck. Yeah, so Chuck, typically no. Since these are sold through the securities industry, they require a securities license to share in commissions. But how we try to position that for brokers, I know this presentation today is, I believe, more client focused. But from a broker perspective, it really allows you to help get your clients off the fence by knowing what the replacement solution is going to look like prior to the property being sold. So from a broker's perspective, getting half of a deal is better than most sides of a deal if a client can't get, if they will not sell if they don't know what their replacement property looks like. I hope that answers the question.
Next one is, does the investor participate in the appreciation when the property is sold? And that was kind of one of my questions, which I'm aware they do, but how does that work? How does the detail of that appreciation work?
Absolutely. Yes, you are a true fractional owner. So when you get your closing statement, you'll see your percent ownership. And if the property goes up 20%, your percent ownership gets capital appreciation of 20%. It's actually outlawed per IRS regulations that they can't have a waterfall or a promote in the DST structure. I think a pretty good benefit over kind of a GP-LP structure of the past. And I'm sure many of you, and I don't know if there's a question coming on this, but about TICs or tenants in common, that was where there was a lot of issues back in 2008, 2009, 2010. Tenants in common has largely gone away and for the preference of the DST, because in a TIC, you only have 35 or up to 35 anonymous investors, and they all had to make unanimous decisions on any property decision of pertinence. So whether in 2008, 9, 10, when you had tenants vacating the premises, you had to have unanimous decision to either re-tenant it, do a different lease, to refinance the property, to sell the property. And, me and Hunter joke about this, it's hard enough for us to decide where we want to go to lunch together, just the two of us. Imagine, 35 strangers trying to make major financial decisions. So again, DSTs have largely become more conservative than the TICs or other GP-LP structures of the past. Again, this, like Hunter said, not home run hitting here. We're with singles and doubles all day long, and we're okay with that. This is for the demographic that has kind of made their money. They just want some solid income, preservation of capital, pass this on to beneficiaries, and kind of enjoy their retirement in sunny years.
Jay, you might want to hit Andrea's question next, because it's a follow-up to what he was just talking about.
Andrea said, what are waterfall and promote that have been outlawed?
It's just in the DST structure. Okay, so there's actually called the 7 deadly sins in a DST structure. These are things you really don't need to know about as a client. I mean, I suppose they are disclosed to you, but you can't refinance. We can't do any major renovations, major structural renovations to any properties. We can't add, wings or a new phase 2 or phase 3 to any multifamily properties, or new storage units. Can't do any of that. We can't. There's no promote, so that's where a general partner in a limited partnership says, okay, well, if I can do so well with this particular asset that we're buying, I'm going to take an extra cut off the top. That is not the case in the DST space. In the DST space, if the property continues to perform well and has, again, like I said, 20-30% capital appreciation, you get your true pass-through fractional ownership share of that appreciation.
And that's the same with the waterfall. The waterfall is basically a structure that allows the sponsor, in your case, to make more money if the property makes more money, right? And so that would not be allowed in a DST.
That is correct.
Right.
Okay, another question is, have there been any defaults and returns? If so, what percentage would that be?
That is a very, very good question. Again, this is real estate investing, and that comes with certain risk, whether you're buying something on your own or in this space would be included in that as well. I'll tell you, that is why due diligence is so very important in selecting which offerings you would want to invest in. Hunter mentioned it, but there was 42 sponsors last year. And as of, what was it, last week, I had 32 offerings available on my platform. I've only approved 10 at the time, and I had 3 favorites that I liked. I had 10 because I can fit a wide swath of client need, but 3, oftentimes clients will say, well, what would you invest in? How would you allocate this? I boiled it down to 3. So we have only had 2 issues, both during COVID, and anything that we've sold. One was a hospitality asset. We very rarely sell hospitality anymore, but COVID related, downtown Nashville, Doubletree by Hilton. Down there, I've stayed at the hotel, I've done a site visit, phenomenal property. COVID hit, and as we all know, hospitality was one of the hardest hit sectors. So that one actually did eliminate cash flow for about 2 years. It is now paying again. It is now the best performing asset in the hospitality space of that particular sponsor. But everything that the sponsor did during that 2-year period while eliminating cash flow was to preserve your principal. So again, like anything, there is risk associated. The other one was a multifamily out in Naperville, same thing during COVID. It had its cash flow cut by 10%, but again, it's also back on track. What you really want to look out for is, like Hunter mentioned, new sponsors in the industry. We don't sell new sponsors to the industry. They see the industry's growing and there's money to be had here. We need to see their track record and that they can not only be good stewards of our clients' capital, but get a nice return and hit on the pro formas that they put together. So it does happen. I couldn't tell you a percentage. I would say it's very small. Real estate in the last 10, 12 years in this country has done very well. So you do need to be very selective on your new investment. That's what me and Hunter really thrive on, is the due diligence and asset allocation for our clients.
Yeah, and I would just add, sometimes I think, like the Hilton story, obviously no one ever wants to see any kind of issues like that, but this sponsor, when we give this buy-sell asset control to the sponsor, I think it's really nice, because when you go through situations like that, they're able to navigate those kind of situations. And this particular sponsor worked with other hotels in the area that were shutting down to actually reach out to them, bring in some of their guests to this particular hotel. And they worked with the airlines, in particular Southwest Airlines, to bring in more of their flight attendants and their pilots. So I think sometimes when you go through the tough times, that's really when I think it's nice to be able to rely and lean on these sponsors to preserve the value of the property and do a lot more than us as owner operators can do on our own.
Sounds good. Thank you. Another one here is, do you have to file a tax return in the state where the DST is located?
Yes, is the short answer. However, we oftentimes have opportunities in state income tax-free locations. So I think we talked about this before we started, but Texas and Florida are big ones. Tennessee is another one that we see a lot of tax-free investments in. But to that same token, diversification is a known risk mitigation tool. If we really like an asset and it happens to be in Naperville, for instance, outside of Chicago, phenomenally growing area, I think the effort associated with having your CPA file an additional state tax return is so minimal. It's really just a year one setup and a quick calculation that it should be well worth the benefits of the diversification or the asset. So state income tax-free states, you do not have to file a return. You'll still have to pay income tax where you are located. And then other states, you will have to file a return to them, but will be credited back to your location. So, we can't give tax or legal advice. We certainly have to wear a lot of hats, but I will always have to defer you to a tax accountant, CPA, or tax attorney for any particulars there.
Okay. The next person here has got a kind of a small example here, just to put in perspective, of a $500,000 property that has a $300,000 loan. My replacement property must be $500,000 to avoid boot, but I will only have $200,000 in cash. So what do you do with this difference? So if you can explain how that works.
Yes, that is a scenario we get daily. So you have a 60% LTV there. You need to replace 60% in leverage, 40% in equity. You have the equity. So the IRS says, okay, for you to get a full deferral on 1031 exchange, you have to meet or exceed your net relinquished sales proceeds. So in this example, it's 500,000. So we can have to buy at least 500,000, or we can go greater. We can always add to our cost basis, and sometimes we do, for further depreciation and tax sheltering benefits of the income. And the second thing the IRS says, okay, you have to use all of the equity in the exchange. So the 200,000 we know needs to be reinvested. And then lastly, it's the debt actually that needs to be replaced as well. So 300,000 in debt here, 60% LTV does need to be replaced. And yes, we can do that and help with that through a variety of different offerings. We can meet most folks' LTVs through non-recourse leverage. Again, I know Hunter discussed it, but non-recourse, you don't apply for it. You're not personally liable for it, but it is attributed to you for tax and 1031 purposes, as well as cost basis and depreciation. So we can really take advantage in the real estate sector of the tax code to really get a nice taxable equivalent yield, hit all of your 1031 guidelines for a full deferral. And furthermore, I'll add on to that. Some folks say, hey, I need to take out some cash. Well, you can do that, and you can do a partial exchange. It's not an all or nothing, the 1031 tax code. It is up to the amount you get to. So if you take out 50 grand, you'll just pay tax on that portion, not the entire exchange.
Okay.
Yeah, the debt's built into these deals. So some, like I said earlier, some offerings might have, to this specific example, some offering might have right at about 60% LTV. So someone comes in with 200,000 and buys them $300,000 in debt, and they hit all those numbers. Some offering might have 30% leverage, and our job is to figure out these numbers and figure out how much debt needs to be replaced, and we can mix and match different offerings to satisfy the debt replacement there. But it's certainly built into the deals, and you receive it just on a pro rata basis based on how much equity you bring into the deal.
One guy's asking about what type of fractional ownership per property. Well, you covered that earlier on in the presentation, and we're going to make this presentation available, right, guys?
Yeah.
Okay.
It'll be recorded and sent out to all the participants.
Yeah. So
fractional ownership, it's, you have these are very large property or properties, sometimes multiple properties inside one offering, but anywhere from, I don't know, call it 40, 50 million up to $200 million portfolios, and you buy a fractional piece of that entire portfolio. So an easy example, $100 million portfolio, if you put $1 million into it, you would own a 1% share of the entire offering portfolio.
What about depreciation? Does the DST owner receive tax advantages?
Yes, this is true. This is true real estate ownership, albeit fractional. You get to utilize all the same tax benefits, including depreciation on your tax returns, as you would if you own something traditionally.
Okay. Somebody's asking about the typical returns, but I don't believe you can discuss returns, right?
Yeah. Let's, if this is something that interests you, please reach out to me and Hunter, and let's have a conversation regarding your specific situation. The return profiles, risk and return profiles range pretty widely in this space, from ultra conservative, called an Amazon facility like the one on I-25, to something that has maybe a little bit more risk. I would probably say, that would be maybe a senior living facility, depending on location and property manager, the operations department, et cetera. So it really depends on what you're trying to achieve. And we'd love to have an opportunity to share with you our full slate of options, current options. It's pretty fluid in this environment. Plenty of offerings sell out awfully quickly, but we bring in new ones all the time. But again, I think just to kind of round that out, I think our risk profile is far less than what it is buying something on your own, given that we're buying institutional quality real estate. And I think the return profile is the same, if not better, of what you could do out on your own. And remember, we're removing all of the effort associated with active property management.
Okay. Can you discuss the fee aspect of the DST a little more? Is there an expense ratio or just the purchase and sale fees?
So they're all very common on the fees for any of the DST. So if we bring this back to the traditional real estate, Brad J, your brokerage fees on a buy and sell transaction, maybe 5-6%, maybe 1% to 2% in third party costs and closing costs. I can make the argument we're every bit of high single digits. We're essentially the same. One large difference that we have in the DST space is those fees don't get attributed to the non-recourse debt that's associated with that. So if you have a 50% levered loan to value offering that you're buying in, we almost cut our fees in half. Again, fees are particular by offering, and I encourage you to reach out to us for a little further clarification on that, and we can show you this is fully disclosed and transparent. It's called an estimated use of proceeds page in all of the private placement memorandums.
Yeah, is there an ongoing asset management fee, Reed?
Typically, yes, depending on the asset that we're buying. If it's a large triple net like an Amazon, a Walgreens, Dollar General, Tractor Supply, something like that, maybe it's 25 basis points on an ongoing basis, basically to collect the payment, reconcile it, and distribute it out to investors. If you're more in self-storage or multifamily, you're 2 to 4%, again, depending on offering, sponsor, size of operation, all things that we look at. But the DST platform or universe, if you will, has really become a competitive landscape, and costs are quite efficient and effective. They are not, they're not running an asset management fee and property management fee to make money. They're essentially trying to break even on that side, which is a good point. Sponsors are typically making money. How do they make money? When they buy a property, they take an acquisition fee. When they sell a property, they take a disposition fee, usually 2 to 3% on each side. So it does really align the interests with the clients. They want to grow the underlying value of the property. So
another question, how does an investor like myself with multiple properties become a sponsor? What's the minimum criteria?
Well, that's a fun one. We've gotten that a number of times. Most of the sponsors that we sell are multi-billion dollar organizations,
right?
With 3, 4, 5, $10 billion under management. That's kind of your core top 5 sponsors, which is who we're primarily dealing with. And maybe we like a satellite allocation. We really like the underlying real estate. The smallest sponsor that we have sold, I think, is 500 million in AUM. I think to answer the question more directly, anybody can become a sponsor, but to set this up legally, it's probably $250,000 in legal expenses just to get going. Would be my response there.
Okay, another one. What's the range of debt replacement available? If I'm purchasing 2 replacement properties, does the debt replacement ratio have to be the same on the 2 properties, or can I allocate more cash to a low leverage DST and more debt to a traditional owned residential rental property at 80-20 loan?
Yes. Yeah, that's a really good question. So it's your exit LTV of your net relinquished property. Okay, so if that net relinquished property is, oh boy, how do I do the numbers here? It's called 50-50. If it's a $100,000 property of $50,000 in loan to replace, can you do an 80-20 loan? So could you buy a $50,000 property with what is that, $40,000 on your 80-20 loan there, and a DST property with 20% LTV? Yes, you could. So it's your exit LTV. You just have to match with what your replacement properties are. So to get to that, in that example, to 50%, and using your numbers at 80-20 and 20-80 on the other side would qualify.
Yeah, and I would just add, yeah, maybe that question's answered, but the range of debt replacement available is a couple offerings at zero, debt free here and there, and then on the lower end of some levered offerings, we're seeing some stuff in probably the maybe high 20s, low 30s, but on average, most of our stuff is in the like I said earlier, probably 45 to 55% range. So pretty easy to put a couple different offerings together if it's DSTs or a DST in a traditional residential property, and structure that just to meet anybody's debt replacement needs.
And we have high LTV offerings as well. We go up to about 83 and 3/4%. So those are zero coupons, so they're hyper amortizing. Again, goes back to what the client's goals are. What are they trying to accomplish? They're trying to buy one property in cash, but they have a bunch of debt to replace. Well, we can get up to, again, that mid 80s in LTV and satisfy, again, a variety of goals.
Okay. Well, that's all the questions from, well, one other one here. Can you trade into a DST for just debt?
I mean,
Yeah.
as the example that I just stated, about 84% is about as high as we can get on the debt side. So if you bring 16% equity, we can get a lot of debt up to about 84%. I hope that answers the question.
What is the minimum investment?
100,000 is the stated minimum on all DSTs. We do enough business with a lot of these sponsors, they will give us some exceptions to go a little bit lower than that. But yeah, 100,000 is the stated minimum for them. So again, Hunter mentioned this, but you have 500,000, you could do 5 different offerings, or it's like some people that just really like one offering, or maybe they have a large balance sheet and enough diversification, they'll just buy one offering.
And so along those lines, you mentioned earlier leftover or boot, as you're calling it. I just wanted to, for those that may not understand that terminology, just make sure they understand what that is.
Yeah, so, and you brought up a good example of that, Brad. So if you say you have $1 million net relinquished property or exchange to replace, and you find something that you love and it's only 800,000, you go and buy that property, you still have 200,000 left over. Well, given the way real estate has gone in this country, you can buy very little, unfortunately, for 200,000, unless you can get a very high LTV on that. So we can accommodate, again, 100,000 stated minimum. If you buy something for 800 and you have $1 million exchange, we can take the 200. We can do 2 offerings, or we can do just 1.
And that leftover is what you're calling the boot. And what if I had $80,000 in leftover?
Call us.
You're saying maybe I could pull that off. Okay.
Yes. No, always call us. I will tell you, I think we may have a record here, but we did a $19,000 trade for somebody one time. Was a good client of ours. And, but we're always, so no ticket is too small for us. I mean, candidly, that's how our business has grown to what it is today. Investors are birds of a feather, and we can help a lot of different folks. Even if you just want to kick the tires with us, we're open to having a conversation. Even if you're not ready to list yet, feel free to reach out to us. The environment moves pretty fast, and Brad and Jay will tell you the same. I think in this environment, depending on what your underlying assets that you hold are now, it's a pretty opportune time to look at repositioning your assets, to take advantage of these, record high prices. Inflation is certainly a concern. Our preference, our investment thesis is to be in short lease duration assets. So multifamily is about 12 months on average, rolling throughout the year. Self-storage is actually only 30 days. Average tenant of a storage unit is about 11 months, however. That way you can dynamically price and hedge against inflation, and therefore rising interest rates, by always driving the NOI. So again, I think it is a very good time to consider maximizing the value of a sold property, with Brad and Jay, and reach out to us, and we'd love to share with you some ideas for what replacement would look like, complete with a hypothetical cash flow analysis for you, and full custom proposal.
And then I just had one last question for you, Reed. And you mentioned a corporate credit tenant when you were talking about some of the office, industrial, retail type tenants that you work with. Can you give us an example of what a corporate credit tenant is?
Yeah, sure. So Ford Motor Credit, Amazon, and I'll even go one better. I'll go government net lease program, net lease properties right now. We've got 3 Social Security Administration buildings. We've got an FBI field office backed by the full faith and credit of the United States government. So that would be a credit lease. But your corporate credit leases are Amazon, Walgreens, again, Tractor Supply, Dollar General, Kroger. Oh, Hunter, help me out here.
FedEx, Verizon, DaVita.
Yeah, it's
Right.
all over the board. They're not only industrial or manufacturing. They could be office headquarters. They could be net lease retail locations. Could be a portfolio of any of these all combined together. Dialysis centers is a great one. We love dialysis clinics. The TI is so good. They put so much money into those that those tenants never leave.
Right.
And it's unfortunately a need in this country that we own those.
So we're not talking mom and pop stuff, as you were mentioning earlier. So, yeah.
No,
No, gotcha.
no, singles
Good.
and doubles.
Right on, right on. Jay, any more questions?
No, all the participation questions are through, and you guys have answered the questions I was jotting down through the presentation. So thank you for that, for handling all that. A lot of good information here that's been shared.
Great. Well, thank you very much, Reed and Hunter, for joining us today. I really appreciate that. This is how you can get a hold of them if you're looking to do that. Let me back up here to a couple of slides and let you have our information as well. So if you're looking to buy or sell anything, if this has sparked any interest in that, give Jay or myself a call. We're happy to talk to you about that. We appreciate everybody for joining, and we'll conclude right now. Appreciate you guys. Thank you very much.
Thanks, everyone.
Thanks, everyone.